This will probably be my last recording for a while. I'm getting ready to leave on my summer climbing trip, and I'll be gone most of the summer. Probably won't get back to Las Vegas until sometime in mid to late August. I might get a chart of the day occasionally and maybe one or two videos, but I'm not going to put a lot of effort into the blog while I'm away. So this will be probably the last video I do for a while anyway. So I want to look at what's happening in the stock market. So there's been a bit of, well, let's just say the cycle counts are a bit fuzzy, and I'll tell you why here. I think if we actually had free markets anymore, without government interventions and global QE and all the nonsense that we've had to endure over the last 9 years, then I think what would have happened naturally is that this cycle low right here would have bounced. We would have gotten a left translated daily cycle, and we would have stair-stepped down into an intermediate cycle low that would have retraced at least 38. A more natural retracement would be 50% of the intermediate cycle. So let me put the Fibonacci retracements on here. So I think if this had been allowed to progress naturally, we would have had a gradual stair-step decline that would have at least gone back to this 38%. But a more natural correction would be back to the 50%, and we would be getting that. We would have either gotten it or we would be getting it now. But the problem is, we've seen this play out over and over for the last 5 or 6 years. Every time the market approaches some kind of a political event, whether it be the Humphrey Hawkins address, the State of the Union address, especially an FOMC meeting, the market is, the market always magically pushes back up either to or very close to the all-time highs, and especially for FOMC meetings, that just gives the Fed cover to make a decision without the pressure of a declining stock market weighing on what they want to do. Well, clearly the Fed wants to raise rates. If the market had been declining rather steeply into that May 3rd FOMC meeting, it would have been hard to continue to maintain that hawkish stance and the intent to raise rates in June. So you get this abrupt U-turn in the cycle, and then the market is locked right at the all-time highs for that FOMC meeting. But because the market wasn't really allowed to correct naturally and clear sentiment, we weren't able to generate a sustained breakout. And what it has done is it's compressed the selling of the intermediate cycle into a very short time frame. So, I mentioned this in one of my nightly reports before, that probably what was going to happen is we would get to the very tail end of the cycle, and then we would have to have some kind of a mini crash, and all of the selling for the intermediate cycle would have to come very quickly over just a few days. And it looks like that has begun. Now here's the problem, and here's the problem with selling short. There is always the risk that the plunge protection team can step in, pre-market one day and ram the futures back up and put an end to the correction. So this is why it's so dangerous to sell short. There's just no way to know when that could possibly occur. Generally speaking, over the last 4 or 5 years, since 2012, it seems like the government doesn't tend to get too terribly nervous until a correction reaches the 38% retracement of the previous intermediate cycle, and then that's the point at which they pretty much decide that enough is enough, and they put a stop to the correction, and then back up we go. So I'm going to assume that over the next 1 to, let's say, 3-4 days, there's a good chance we come down and break this March low, which normally wouldn't happen on a right translated cycle, and this is a right translated cycle. But like I said, I think this was an artificial rally here at the end to protect the market ahead of the FOMC meeting, and now they've forced the intermediate cycle to correct. The correction has been compressed into a very short time frame, so it's got to happen very quickly all at once. And so I'm going to say that there's a decent chance anyway that we could get down to test this 38% retracement over the next 1 to 3-4 days. But if history repeats, they're probably not going to let the market go any deeper than that before they turn it back up. They don't want any of these corrections getting a lot of momentum, like what happened at the 7-year cycle low in the fall of 2015 and the spring of 2016. They don't want a repeat of 2011, so they just don't take a chance anymore. The plunge protection team is no longer reactive; it's proactive. They've learned their lesson. As long as they keep the stock market propped up, you can head off recessions. You can't have a recession as long as the stock market is propped up. So I'd say the odds are 50-50 we can get down to here over the next few days. But after that, if you are short, I would be covering those shorts quickly. I do not think they are going to allow the market to correct any deeper than that, although I think a normal intermediate cycle correction would go down to the 50% retracement. I doubt that they're going to let the market get that much downside momentum before they step in and stop the correction. So anyway, I'm going to say we've got somewhere between 1 and 4 days maybe for this to complete. Short-term sentiment has gotten pretty bearish after today. We might have to get a little bear flag for a day or two, and then finish the correction maybe in the middle or end of next week. But I don't expect this to last too much longer, and I really doubt that they're going to allow this to go past that 38% retracement. And then this is going to be your buying opportunity for the best buying opportunity you're going to get for the rest of the bubble phase. This will be your chance to get in to full positions, and personally I would prefer the NASDAQ because that's leading the charge as it does. All markets are led eventually by tech. That's where the innovations occur. So I think your best bet is probably just to focus on the tech sector, and I would love to buy biotech, but I'm nervous about the biotechs and the healthcare sector because Trump has been pounding on the sector from time to time too, and you just never know when he's going to come out with something, a threat to regulate the industry or something that could affect profitability and innovation in the biotech sector. So while I would love to invest in that sector, the political climate has just made me a little too nervous to do it. So I think a safer bet is just to bet on the QQQ, the NASDAQ 100, and wait for the NASDAQ to reach 10,000, which I think it will do that very easily over the next year.